This is Declarations.
The investment returns have proven to be very successful in a number of asset classes other than the S&P 500. But real estate, as you know, has been great. Venture has by and large been fantastic. Private equity, but not only are there pockets, right? The areas, and we've had very good luck with investors whom we've chosen and worked with, year after year. But we recognized that there was a sex appeal to these asset classes. It wasn't just that we believed there were opportunities. We believed that individuals and families were going to be asking for this. It was something that was going to be part of the so-called lexicon of investing.
Hi, this is Todd Rich, co-founder of Declaration Partners and head of our real estate investing business. Welcome back to the Declarations podcast. The purpose of the Declarations podcast is to engage in deep conversations with thought leaders in investing and investment. We are particularly focused on hearing from individuals with an independent perspective. Our goal with the podcast is to try to understand the foundation behind the success of some of the world's best investors and to understand the source of their inspiration. Hopefully, by hearing their stories, we can all become better investors. We are excited to welcome today Kari Firestone. You likely know Kari for her successful career as a stock picker and her frequent appearances on CNBC's Squawk Box and Halftime Report. After 22 years at Fidelity, where Kari became one of the first women in a senior portfolio management role. In 2005, she co-founded her own firm, Aureus Asset Management, where she served until recently as executive chairman. Aureus was at the forefront of an innovative investment trend, utilizing a so-called contemporary endowment model to selectively add private or alternative investments to the portfolios of their wealthy family and individual clients. Outside her career in investing, Kari is also an active member of her community. She has been active for many years with the Boys and Girls Club of Boston, as well as a trustee emeritus on the Beth Israel Deaconess Medical Center, where she continues to serve on the investment committee. She's the former board chair at the Commonwealth School and has been involved with Harvard University in various roles. An avid runner, Kari is a member of the Boston Athletic Association that organizes the Boston Marathon. On most days, she bikes into work from Brookline. When she isn't on her Peloton or playing jazz piano, Kari spends time with her husband, 4 children, and 6 grandchildren. I'm also proud to mention that Kari, as well as several of her clients at Aureus, have invested in Declarations' real estate strategy. Kari, a warm welcome. Let's dive into it.
Todd, thank you very much for having me. I really appreciate it, and that's a very nice introduction you just gave.
Oh, certainly glad you're here. Well, as you heard, I like to think of a declaration as really a mission statement with an aspirational nature. Maybe it's a set of guiding principles similar to those laid out in the Declaration of Independence. So with all of my guests on the podcast, I like to start in the same way. Kari, what is your declaration?
I make an effort to listen carefully when I talk to people I encounter, whether it's casually, such as when you're in line at TSA at the airport or in a store, or with my colleagues at the office, with my friends, and with my family. I feel I learn about people and I learn from people. It's important for our own well-being, mine, and for the people I interact with. And so I come away with it feeling that each encounter enhances my life and hopefully benefits our community as people on Earth trying to do something positive for each other. And that, to me, is a goal I just very much want to continue to pursue.
Well, it does not surprise me at all to hear that you define your mission really as listening and learning. You've been a lifelong learner. Let's go back to the beginning, right? Your own personal background. I've heard you describe yourself as a poor Jewish kid from Brighton, working class suburb of Boston. But learning was central. You attended the Commonwealth School. And I think it was in the 5th or the 6th grade that you first had your exposure to investing by joining a stock picking contest. Is that right?
Yeah, well, it was very interesting. I had the same teacher for 5th and 6th grade, and the Boston Public Schools at that point had an accelerated program for every region of the city. And our teacher, Mrs. Culhane, must have been interested in stocks. And she asked us all, this wasn't by choice, it was an assignment. We had to pick 5 stocks and we plotted them every day. So that meant you had to
Was
get
that
the
hard
news.
for you to just pick 5?
Well, yes. In fact, it was hard to pick 5 because once you started to hear about everybody else's stocks, I mean, my stocks were Avon, IBM, Eastman, Kodak, I don't know, Flying Tiger, Xerox. But you heard about everybody else's stocks and said, oh my gosh, I could have picked Disney or I could have picked Exxon. There weren't that many big names, but if you heard,
Right.
it was Esso at the time. If you heard about them, you thought, oh gosh, maybe I should have bought that. And we could trade once a month and everybody plotted their stocks every single night. And then once a month, we brought in all of our information and you could sell your stock, buy something else, keep track. It was a little complicated, in fact. I just became fascinated with the market.
And I think I don't know if this is true or just an apocryphal story I heard, that you were so committed to the markets or so fascinated that you would every day on the walk to the T station, you would look at the stock ticker around Merrill Lynch's office. And then I think, if I remember, was Charles Merrill may have been even the head of the Commonwealth School at the time. Did you ultimately parlay that into an investing career?
Yes, I guess so. So I went to what was called Girls Latin School. It doesn't exist because Boston Latin is now a co-ed school. And I decided at a certain age, I was in 10th grade, I left Girls Latin School. I wanted to go to a different kind of school. I went to a school called the Commonwealth School, a private school started by a man named Charles E. Merrill Jr., whose father, Charles E. Merrill Sr., started Merrill Lynch. And it was in Copley Square in Boston. And there was a big Merrill Lynch office in Copley Square with a ticker tape around it. And I had been following stocks, right, since 5th grade. I mean, I didn't have anyone in my family who owned stocks, but I followed the names that I had, bought in our quote contest. By the way, I didn't win that contest. However, I watched the ticker tape every single day in the afternoon. So I watched, and then it occurred to me that Mr. Merrill might have some connection. And I asked him if he could please arrange an interview for me with the head of the office. And he left me a message, which was 3 p.m. Friday meeting, Bill Straught, manager of Merrill Lynch. And then it said in all caps, wear a skirt. So I did wear a skirt and I got a part-time job and I did everything at that office you could possibly do that was legal, meaning I couldn't execute trades, right? But I knew how. And I opened accounts, I closed accounts. I did anything that the sales assistants did. I could, run the switchboard. I understood everything about the mail, who got what. It was great.
Yeah,
It was really
what a
great.
great experience. Now, is it true that even though he helped you get that first job with Merrill Lynch, that Charles Merrill also admonished you not to become a capitalist?
Yeah, he was very, very worried I'd be a capitalist. He and his dad did not get along at all. And I promised him I wouldn't. I said, of course not, Mr. Rell, because I didn't understand what the word really meant.
I guess
I said, but I'm sorry, Mr. Merrill, RIP. I used my role in capitalism to help the school also. So I don't think he was upset too much.
fair enough. Well, you won't hear criticism from me for becoming a capitalist. So then after Commonwealth, after your experience at Merrill Lynch, you then went to Harvard undergrad,
Mhm,
and I think it was quite a class that you were part of. The same class as Steve Ballmer, Glenn Hutchins, Jim Cramer, Bill Gates.
mhm.
Did you ever think that you might have done better in life if you had also dropped out like Bill Gates?
I don't think so. But it was wonderful people in that class, and I'm really proud of class of '77.
And now after undergrad, you went back to Harvard, right? You got an MBA before you worked at Fidelity.
Mhm.
Uh, and in Fidelity, you worked for Peter Lynch, who, as all listeners likely know, is just a legendary stock picker running the Magellan Fund. What initially drew you to Fidelity, and to what do you credit that experience, Peter Lynch?
So after college, I worked in an investment company in Boston for 4 years because I was interested, right, in investments. And I got married, and I was limited in where I could apply business school and where I could work because my husband was in a family business in Boston and he wasn't going to move. I applied to 3 places in Boston that I thought were the top investment buy side institutions. And I was very fortunate that I got a job at Fidelity. And Fidelity was the type of environment where it appeared to be a real meritocracy. If you worked very hard, you were going to do well. And it might have been founded by the Johnson family that were, kind of old line Boston Brahmins. But Mr. Johnson Sr. and Ned Johnson, they hired people who were really committed to just working hard and figuring out the market and beating the market. Peter Lynch was the manager of Magellan Fund when I arrived.
Yep.
He had 2 assistants full time. He owned 1,000 stocks in Magellan. The
Wow.
research department had, I can't tell you for sure, but I think that there might have been 12 analysts in the research department and 1,000 names in Magellan. So he needed another assistant to help with following companies. And because I had experience in the market, because I'd worked at the Boston company, they hired me to start working for Peter as one of his assistants, which was an amazing opportunity. And it was learn by doing and, get thrown into the fire, but really an amazing experience to watch someone of Peter's ability and learn from listening and seeing what he did every day.
And was it Magellan and Peter in particular are credited with beating the S&P 500 consistently and with actually pretty high margins
Right.
for a long period of time with 1,000 stocks. How did he do that? And is that possible to replicate today?
Well, I'll start with the latter. I think it's not possible to do it today because following 1,000 companies, where there's so much information available, there's so much you have to know. It would be overwhelming to have in one fund, particularly a fund of size. Peter would zero in on certain industries that he thought were in a great state of change, great flux that would be positive. I was involved with the gaming industry and hotels, and I'll tell you, just as an example, Peter had me go to Atlantic City, and I think I visited all the casinos there. I got to know them as they were being built, the owners, the managements of all of those casinos. And then I flew to Las Vegas, and no one was going
Did
to
you
Las
ever think
Vegas.
one of them was going to become president?
I did. I met Donald Trump and his brother Robert Trump. I mean, I remember being at opening ceremonies at both his casinos in Atlantic City. All of those casino people, I mean, they're quite flamboyant. Everything's the best and the greatest. It's terrific. It's fantastic. What was interesting to Peter that was at Las Vegas, which was really in the slumps. I mean, no one went to Las Vegas in the 70s because it had been tainted by a lot of mob related arrests, and it was considered just kind of a haven for bad incidents. And families certainly didn't go there, and
Right.
it wasn't
You were
haven.
drawn to that somehow.
Yeah, exactly. So, but I went to Las Vegas, and Peter said the weather's great. There's lots of land that's available. It's not very expensive, and all they need is an airport. I mean, Peter. He
Wow.
had that right. They
Vision.
just needed a big airport, and so we began to visit all of these casinos. I went to Las Vegas so much in 1984 and 1985, but I got to know all those managements again, and we were owners of all the companies. The Wynn casinos, he started with Golden Nugget downtown, and then he started with the Mirage that he'd won in Atlantic City, but then built Mirage, built Bellagio. I mean, we were big owners of that, and Circus and Caesars and the Tropicana, Sahara. I knew them all very well, and that was
It worked out well for the investors, worked out well for you. You rose up the ranks pretty quickly at Fidelity. You ultimately became your own portfolio manager. You were no longer just helping Peter Lynch. You now ran your own fund, the Destiny Fund. And I think at its peak, it had over $12 billion of client capital. So what did you learn? Maybe I'd like to get into, so what are some principles that you apply or some lessons that you could teach our listeners on the world of investing that were crucial to you, both forming your own approach and that might be relevant for other people to learn as well?
well, the most important is that number one, it's very hard work, and the work is predicated on looking at so many ideas, most of which you're going to reject because they won't pass the test. This is not an easy industry. We all understand it's about research and it's about getting to the heart of what makes a company better than the investing world believes of it at the time. You have to look hard. The essence of great investing is you find what is unrecognized by the market. Most businesses are well understood. Most stocks are well understood. But then there are some where there isn't the appropriate understanding. I mean, this is an example back to the casinos. If you're the Sahara Resort and you're sitting on, you know, 75 acres of land where either somebody can put a bigger casino or develop the property, that will be much more valuable than the $3 a share that Sahara was selling for the day I visited.
Now you're pandering. As you know, I'm a real estate investor. So
Yeah, I know. Well,
or
but
as
it's true. I mean, definitely you guys are fantastic. But what you do and what we do are not that different in that you're looking for what's unrecognized by the market.
all this sounds like just true value investing at its core, just finding a nugget that other people are not noticing.
Yeah,
Now,
and I would say, just to be clear, I think of myself as um as a growth investor, but growth investors must find the value. Again, there has to be value that is beyond the price you're paying. If everything is appropriately valued in that stock price, if all of the future cash flows are embedded in what you pay, you're not going to get any return.
clearly, you felt confident after by this time at picking individual companies. At what point did you realize that you could also run an entire fund? At what point was it, because I imagine the skill set that it takes to run a fund or ultimately to run a business, which you've done, is a little bit different than picking an individual company to an individual security to invest in. So when did you realize, hey, I can do this?
Mhm. So, my journey at Fidelity was different in one respect to most of my peers because I had four children by the time I was 30. There was no woman at Fidelity at the time who had any children. And
Wow.
the men had children.
So,
Most of them didn't have four.
were there that many women to begin with in the world
No,
of investing
no, no, no. There were
the
very few women, but they didn't have any children.
right?
And I had four, but I didn't work part time. I worked full time. And I knew that I needed to be patient. I had um, the luxury, let's call it the luxury in a way, was the opposite. But I had the luxury of years where I was not running a big diversified fund. I ran sector funds. I ran more sector funds than I think anybody else, certainly in the 80s and 90s. But I was able to think as a portfolio manager. I was both an analyst and I was a fund manager of many different sector funds.
To learn all the different sectors in an economy.
Yeah, I learned a lot of sectors. And that research effort helped inform the decision making that I was going to make when I finally got a diversified fund because I'd followed so many industries. And while, of course, all of the fund managers would have the research department to call on, you could have any analyst help you make decisions. I did that, but I also I knew a fair amount myself.
Now, you mentioned you did all this while a new mother of four children.
Mm.
How did you balance all of that?
Not well. No. Let's start with my husband. I mean, I was really lucky that I had a husband who supported my decision to work full time, but we had very good help. I employed most of the town of Brookline to help. No, my mother was around, my mother-in-law, my father-in-law. We had two nannies.
Like
One of them lived with us for 20, she stayed for 24 years. Housekeeper 36 years later still helps us. I was really lucky that I had such great support from my family and help from people over long periods of time. But I also had to be very organized. I was a very organized person.
And it's impressive that you did that. You rose through the ranks. You ran an important fund. You also raised your kids well. So, a lot of success.
Oh,
Um, but somehow, after 22 years of doing this at Fidelity, you decided that that wasn't enough, that you wanted more. And specifically, you decided to found your own company. Now, I've heard you say that one of the big decisions once you decided to found the company was to go it alone or to do it with a partner. Ultimately, obviously, you decided to found the firm with a partner, with David Scudder. What led you to that, both the decision to found the company and then to do it in partnership with somebody else?
I had an interest in building a business. I'd say for a few years, I had an idea, even something at Fidelity, which was possible, which if there were 100 families at Fidelity that had 50 million or more, that was um, undirected, meaning Fidelity didn't give advice to people in those days at all. They just said, well, here are our funds picked. I said,
Right.
well, maybe I could be the fund manager I could manage those families' assets. And so that was an idea. It wasn't an idea that
You
at the time
tried to do it with Fidelity, you're saying.
I asked if this was something that made any sense. And correctly, the executive whom I spoke to said, Kari, you manage $12 billion now. Why would we want you to manage five? Never really thought of that, but good point. And then I thought, all right, I'm not going to do this inside Fidelity, but maybe outside Fidelity. But when you leave Merrill Lynch or Morgan Stanley as if you're an advisor and you leave and go to another shop, if you have a hedge fund, you're working for one hedge fund and then you move to another, that's different. That's easier in a way. I didn't know the people who invested in my fund. I didn't know them personally and they didn't know me. And most of them didn't have enough money. They weren't going to have 10 million to have us manage at the new company. So I thought, okay, I can't count on myself for bringing in the clients. And maybe they'll be more skeptical of a woman. I thought that was a real consideration.
You think it
And
actually played out that way, or tough to tell because you ended up partnering with a man?
I think there's some evidence that it's true. I'll tell you in a sec. So then I had a friend who was, I had known from my summer. I spent a summer between years at business school working at Wellington. He was a partner at Wellington, David Scudder. Um, and they mandatory retirement at 60. And then he went to work at Harvard Management Company for a number of years, but he was interested in doing the same thing. I knew that David Scudder had a real network of people who trusted him. I mean, he's a very, I would say, high integrity, intelligent, thoughtful, and endearing person who I figured would have many connections that would be good for our business. It turned out I had more than I thought. I just didn't know for sure. But the people for whom it took longer to attract to Aureus would be people who might have been CEOs of companies that we had invested with at Fidelity or companies that I had followed as an analyst. And they wanted to see a track record. They
Right.
wanted to see what the new company's track record was going to be. And they did, and they saw it. And then eventually, a number of them became clients at Aureus and still are, but that did take a few years.
Hi, this is Todd Rich. Thank you for listening to the Declarations Podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations Podcast, please visit our website at www.declarationpartners.com. And now back to the episode. So let's just go back to the beginning. When you founded the firm, you must have had certain founding principles, certain ideals that you wanted to hold true to, and then you must have had an aspiration of some sort.
Yeah.
I'd love to know what are those founding principles? What are your aspirations for Aureus?
We believed that whatever we offered to our clients, we wanted to do it better than the competitors who offered something similar.
Okay.
Meaning, if we were offering them a portfolio of equities that we chose, we wanted that performance to be better than what they might be getting at, whatever, XYZ investment management. We
Right.
wanted to give them better client service. If we offered them alternatives, we wanted to provide something that was unusual. And at the time, it definitely was unusual for individuals and families who didn't have hundreds of millions, who
Right.
weren't major families, to be able to invest in venture capital or real estate or private companies. And
Right.
that was,
And I think you guys were really at the forefront of this. And I think perhaps it was David who termed this, but you guys at Aureus were one of the first to offer a contemporary endowment model. Um,
correct.
and I think that was largely an attempt to try and mirror some of the private investments that the large university endowments had done, but to do it specifically for families and individuals. Is that correct?
That's exactly right. And it was part of his being at Harvard Management Company, right? And so he saw how they invested. And it was not, of course, the 70% equity, 30% fixed cash, that so many investment firms offered to families and individuals. This was something that was broad asset allocation across many asset classes. And he believed in that strongly. And we both did. It was where the world was going, right? But we certainly saw that there were ways to invest in fairly illiquid asset classes that had been unavailable other than for big endowments and foundations.
As you started to think that through, right? Presumably, family and individual investors should approach those or could approach those investments a little bit differently from some of the institutional counterparts, right? There are different tax regimes, for instance, different liquidity needs, different carry requirements, right? Families don't often have to support the budget of a particular university, for example.
Yeah.
How does that, how do those differences inform the investment approach that you guys took at Aureus?
So it's a very good question because as you know, at Declaration Partners, all individuals or families are not created equal.
Right.
Some of them have wealth that's being generated by a type of family business or a sustaining income level, and some of them don't. Some of them have inherited assets that might produce a small amount of income, but definitely not enough.
Mhm.
And the investment returns are required in order for them to maintain a lifestyle. You don't want to ever get into a situation where you have too much that's positioned in the illiquid bucket, and then they can't get anything out of that.
Although the
And
one thing I think that they all seem to have in common, though, is this desire to utilize illiquid investments as a way to generate excess return, acknowledging that the illiquidity has risks, which is what I think you're pointing out. And so you have to think about position sizing. But I think they all believe, and maybe this is what you believe, is that investing in illiquid assets can generate excess return, can produce diversification benefits. Is that the thesis, the crux of what you're trying to do?
so there's two things that are going on. One is that the investment returns have proven to be very successful in a number of asset classes other than the S&P 500. But real estate, as you know, has been great. Venture has by and large been fantastic. Private equity, but not only are there pockets, right? The areas, and we've had very good luck with the investors whom we've chosen and worked with, year after year. But we recognized that there was a sex appeal to these asset classes. It wasn't just that we believed there were opportunities. We believed that individuals and families were going to be asking for this. It was something that was going to be part of the so-called lexicon of investing.
Which is
Foreshadowing.
fascinating, right? Because when I think of an investment crisis, right, something like the GFC, I often think about a lack of liquidity hitting the public markets, right, hitting the credit markets. Perhaps we're even in one of those moments now, but I'd like your view on that. But when I think of that, I don't think of investors saying, "Wow, all the liquidity is dried up in the public markets. What I'd like to do is invest even more in illiquid private markets." But you're saying that's exactly what your investors wanted.
This is what we thought they would want.
Okay.
Okay, we hadn't heard that. We just knew it was coming. We had been looking at some venture funds. We hadn't made any decisions to invest yet because we thought in 2007, for example, early 2008, 2008, that there was a bit of a, extreme pricing bubble going on in certain markets. It definitely was going on
Yep.
in a subprime market, but we waited, and that was good to be patient. And then in 2009, we went back to firms and said, "Did you raise enough money for that fund?" And the answer would be no. And so we said, "Oh, have you made some investments we might look at? What do you have in it? And how much more money do you need to raise?" And those were very fortuitous times if you had the liquidity to invest.
It's fascinating. In many ways, I do believe that that's an advantage that, private individual wealthy family investors could have, right? Which is that they don't have to run it by an institutional investment committee.
Right.
Have conviction, they can go and do it. And, it does seem that it's easier for families to reach that level of conviction, even in the absence of other people getting it. And so
Mhm.
good on the timing. Now, let's go back to a question that I alluded to then. Do you think we are in a similar time? It's obviously a very difficult fundraising environment for most funds. Private, funds, particularly those that have used leverage as a component, are facing an increase in the cost of debt, perhaps a lack of availability of debt. Is this a similar moment?
I don't think so. I I think what we're facing right now is still part of the COVID related decade. And I have to say COVID related because you don't have the pandemic crisis that we had, but we have the repercussions. And so it started in 2020, and I think it's going to go until 2030. And what I mean by that is we had an enormous crisis at every level. Monetarily, the way we handled it was to provide funding for the world. We gave everyone money so that they could live as the world shut down. Then this created, by necessity, a lot of inflation, and not just the price of chicken, but asset classes. And then to deal with the prices, the Fed raised interest rates. So now we're doing the unwind. You reap the success, and now you have to suffer for a few years because of interest rates, which were necessary, had to go up, and now they're going to come down. But I don't think that
I don't think
there's
you
anything cataclysmic about this. I think this is a natural unwinding, and there was too much money raised in many places: public markets, private markets, real estate.
It does sound like your view is that there needs to be some sort of reallocation. I'll use the word recalibration just to play off of Jay Powell, but to recalibrate our portfolios. It
But
sounds
yeah, but recalibration is different than um, what happened in 2008 and 9. The world was so unstable
right.
that we really needed governments all over the world to come in and bail out most financial institutions. And that it's not happening right now. And if it were to happen
Not yet.
with, I mean, let's sort of take some big insurance company, perhaps, or even a bank, but I can't imagine it exactly falling through this way, that has real estate, too much real estate that is held at very high prices relative to where the prices are now. It's going to be isolated. I don't think you're going to have massive government bailouts of big companies today the way we had then. We also have very little unemployment. When you have 4.3% unemployment, it's very hard to have a recession.
I think your view is consistent broadly with what we're seeing as well, which is that asset prices have needed to change, principally asset prices in levered asset classes like real estate, as you mentioned. But the fundamentals are fine. So it's really just a balance sheet fixing. That creates actually pretty interesting investment opportunities in our view. I want to go to something else because you're far more interesting than just investing. You also wrote a book. So in 2016, I think it was, you published a book called Even the Odds,
Mhm.
and really focused a lot about risk. You published what you called the four tenets of risk. I think sometimes in lettering, so I'll call it the four R's. That one, right size your risk. Two, right time your risk. 3, rely on your knowledge and experience. And then 4, retain a healthy skepticism. So can
Yeah.
you elaborate on those lessons and then why you chose to, codify them in a book?
Yeah, sure. Thanks. Um, just on the question of why did I write the book and what prompted me, I've always been interested in risk taking and thinking about risk. I mean, from the time I was very young, I would take a piece of paper and draw a line down the middle, and it would be, I should on one side and I shouldn't on the other, and I'd always do this about decisions.
Angel and devil on your shoulder, I guess.
Yeah, yeah. I mean, that's what I like to do that. I mean, I still like to do that. But I had asked Jim Cramer, this is many, many years ago, why was it we had very good numbers, but we weren't attracting enough new business? And we didn't do any marketing either. But he said, just write a book. I said, well, what do you mean just write a book? He said, you're a good writer. We were on the Harp Crimson together, Jim and I and Steve Ballmer. I said, you can write and you haven't had an interesting life. Just write a book. I said, much easier said than done. Is it hard? Yeah, it's
That
really
was.
hard. I wrote articles first. I began to write articles for Harvard Business Review. Um, I just wrote for Forbes. I wrote for all sorts of publications. And when I had enough written, I put together, proposal for a publisher. And it was about this concept of risk taking in business, investing in life. And right sizing. So people, I've decided over the years since I wrote my book, are good at some of these and are not good at others. So
Okay.
right sizing, it's amazing how imprecise most individuals are in terms of the risk that they're taking. Often they take too much risk in a place and they go, oh, I didn't realize that this was going to like put me over the edge,
Right.
because the size of whatever risk they took, whether it's starting a business or deciding to move when, you don't know anyone, you don't have family there, your spouse doesn't want to do it. The size of that risk is tremendous. And you really have to think about how it's going to affect you financially, but not just financially, your entire family, right? The timing of the risk is the one that I have the most trouble with. I think in the investment business, particularly in public markets, timing is essential.
Right.
And if you get it wrong,
Very hard to get right.
right. I learned this, I guess, the hard way. For years, we were allowed to short stocks at Fidelity. I'm talking about, 30 years ago. If the fund didn't own a stock, we could short it. And when I followed biotech, those are very binary outcome names. And if one believed that a clinical trial was not going to work and we didn't own the stock, I shorted stocks often. And
Wow.
I was right at times, but when you're not right or it's delayed and the price keeps moving against you, you understand how important that timing piece. It's like, big deal. So timing, essential, knowledge and experience. You know what you're good at. You know what it is that you've been successful at, and stick with it. And people often don't. They somehow get steered into the wrong direction. They make choices to do something that does not take advantage of what they have spent decades amassing an experience and skill set about. And that's a mistake. You're best at what you've been doing if you've been successful doing it. And then on the skepticism, people try to sell you junk all the time. I mean, if you're in the sales business, you're selling. Doesn't mean it's going to be great. Doesn't mean that the person is lying. They may believe it himself or herself that this is the best investment you're ever going to see. But you have to have your eyes open and do your own homework and not trust anybody else.
Carrie, one of the things that I love is when you talk about risk taking, it was not specific just to investing. You talked about, moving cities or doing things that are not related just to investing. And I love that framework. Okay, can you talk a little bit about how you measure appropriate risk taking? I mean, is this based on the outcomes? Then you'll know whether or not you took the right level of risk, or is there some process that people should be following? And how do you then apply that to your own life?
You can't in the life effort always measure things and quantify it. You can, of course, financially. but you have a sense of satisfaction that relates to the outcome, whatever you've done. It's led you either to feeling better or worse. Did you
Right.
think about that before you made the choice?
You've described both an intellectual and an emotional feedback, right?
Yeah,
Intellectually, you're listing the risks, but ultimately the decision seems to be guided in your framework by how you then feel once you think about these things, which is
yeah.
a fascinating framework.
Yeah.
Um,
If when people have made a risk financially, and the outcome is bad, right? The bad outcome always outweighs the good, even if it's an equal amount in terms of your sense of well being. You always
right.
feel worse by the same level of loss as you do by gain. So you have to again, factor that into the equation for the next time you make a choice about risk. You have to say, I have to discount that feeling of pain because it's too great. I shouldn't give it, I should not allocate it as much because I won't then make a decision, a smart decision to take a chance the next time because I've given too much power to that disappointment the last time. You have to compartmentalize these
So
choices.
let's talk about a choice then that you recently made, which is a change, maybe not a risk in the same way, but it's a change certainly, which is that you recently announced that you'll be retiring from Aureus in 2025. So you're going to continue on, obviously, as an advisor, and I think you'll continue with your appearances on Squawk Box. But what is next for you? What is the new change that you're making?
I tend to like being busy, and I
No,
have no doubt that I have many things to keep me busy. What I'm not um, going to do, I think, is be busy from 6 a.m. until 8 p.m. with just our company. I mean, not that every day it was like that, but I've really
it's just
limited.
hours between 8 p.m. and 6 a.m.
Yeah, that I just I like many things. I have many interests and activities. I've been on a couple of public company boards. I'm on a private company board. I'm on the nonprofit boards. I've um other interests with those boards. I like to do more. I like to play tennis. I like to play bridge. I like to play golf. I like to play piano. I don't have enough time to to do all of them, and I have kids and grandkids, and I haven't felt shortchanged in my life, even though I've traveled much less for pleasure than most people I know. I mean, I travel a lot for work, but I don't tend to do these things like go to national parks because I don't have any time. So
Right.
I want to be able to add some other things to my life and not feel that I missed things.
But it's interesting because you have carved out time to do a lot of things outside of work, right? And you've touched on some of your community involvement. But I actually, it's really impressive the way you've given back to the community philanthropically, right? And so that, as you said, that includes some board positions at Commonwealth School. You've been involved with Harvard, the Boys and Girls Club of Boston, Beth Israel. Um, what is driven from a time perspective, from a capital perspective? What has driven your philanthropy?
Well, the first thing is, I believe that you have to help the organizations that have helped you. And I had a scholarship when I went to the Commonwealth School, and Harvard was the same. I had a scholarship. I was really happy that they took me, but they gave us money, and I was a lifeguard. I bartended. I did catering. I did a lot of jobs at Harvard, which I actually liked the jobs too, but I felt that it was an important thing afterwards to give to Harvard, and I felt that about organizations that help children. I had 4 kids at the Beth Israel Deaconess Hospital. It as a Bostonian, it's really been worthwhile for me. I feel it's been um, a gracious thing for me to do, and that I should do. It's given me great happiness that I've been able to help organizations that are part of this community and have helped me.
Well, that's great. And Boston is such a wonderful city in part because of all of the people that give back. My wife, as you know, is from the Boston area, so I'm a huge fan. Um, and thank you for all that you've done. Let's move to our standard closing questions here at the podcast.
Mhm.
So first, what is a book that most influenced your thinking or your personal development?
I read a lot, so it wasn't that easy for me to narrow this down, but I did. Um, and the way I came about this book is I thought, what book have I given to my friends?
Let's hear it.
So it's called Lush Life, and it was written by Richard Price. Richard Price, he wrote it in 2008. He's one of the writers for The Wire. Lush Life, it's one of many books he's written. They're usually crime novels, and it's beautifully written and it's beautifully spoken. And the story has all sorts of twists and turns and a detective whom you can identify with. It to me, this is what I love in books where I
Good.
can relate to
I
so many parts of it.
Best advice that you received from your parents or that you've given to your own kids?
My mom who raised me she was not great at giving advice, but she showed me that it was very important to work hard and to be committed to what you were doing. So if you're a student, you got to be committed to getting good grades. If you're a friend, you have to be a good friend. Um, you take your responsibilities seriously and are reliable. And that's the way I've lived my life. Just she had she was a model of a person who did things with an enormous amount of kind of belief and support for, her family. And that's what I've tried to emulate. In terms of my children, if you ask them, I'm not sure that they would say I was so great at advice, although I certainly give play in it. But I have said to them that you should find out what you really like to do because you're generally going to be good at that. And if you're good at it, hopefully you can make a career of it.
So as you know, the Declaration of Independence talks about freedom for life, liberty, and the pursuit of happiness. So what do you do in pursuit of happiness?
So I'll tell you just a story about happiness briefly. This was about 20 years ago, and I was running at the Boston College Reservoir, which is about 1.6 miles. It it's a reservoir that is partially in Boston, Brookline, and Newton. So those are the three communities that adjoin near where I live. And I grew up on the Brighton side of the BC Reservoir. We used to sneak in and swim there all the time when it was fenced off. And I was running with a friend who had spent his life working for the post office. And it was a fall day and it was crisp and there were a lot of people with their dogs. And he's looking around and he said, "It doesn't get better than this, does it?" And I said to him, "You're right. It doesn't. This is incredible. We're out here running and it's beautiful and I loved it. And there was nothing about it that was exclusive and it wasn't fancy and it was just for anyone." And I thought, I don't need a whole lot to be happy. I've had a very blessed life in so many ways. And I believe that happiness is about experiencing with people what makes us feel good, makes us feel that people care about us and listen to us and we're doing something together. And that's what I want for me and my family and for everyone I come in contact with.
Let's end on that extremely positive note. I wish that you find that happiness again on your next run. Uh,
Right.
what a pleasure. Thank you so much for joining us, Kari. Really appreciate it.
Yeah.
And you
Thank
again.
you. Thank you, Todd. Take care.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners LP, together with its affiliates, referred to as Declaration or We. This information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment products' definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment and must be able to bear the risks involved. This podcast may contain certain forward-looking statements, which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that these such views are correct or will prove with the passage of time to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rights, among other preferential treatment, which may pose a conflict of interest. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision, including any investment decision, should be made based on this podcast or on the information contained herein.